not. Okay. All right. Well, hello, everybody. Thank you very much for joining us today on the Enhancing the Accountant Bookkeeper Connection series. So for those of you who don't know me, I think everybody knows me these by now, but that's myself. I am Tanya Hiltz. I'm a certified professional bookkeeper and founder of Cloud Bookkeeping Services and Tanya's Bookkeepers Bootcamp. A little bit about myself professionally and the accolades. I am not going to go through all of these. You can certainly read through if you would like, but just to point out some of the most recent ones. I was the recipient of the 2019 Professional Leader of the Year through IPBC, which for those in the States or don't know what IPBC is, that's our Canadian National Bookkeepers Association. It stands for Institute of Professional Bookkeepers of Canada. Our Bookkeepers Bootcamp actually qualified for IPBC continuing education credits in 2018, which is a big deal. We are the only member run program that actually does qualify for continuing credits like that. And of course, we were the Intuit Global Firm of the Future finalists for 2018 and still reigning because I guess we broke the contest because there's no more after that. So that's a good feather in the cap. I'm sure we'll come out with something else for this year, next year. Something slightly different. And we were the Canadian runner-up for 2017. And then we were also one of Practice Technician's top 50 women in accounting globally for 2018. Yeah, a bunch of other stuff, but like I say, that is the most recent and that is awesome. So thank you everybody who has, participated in the voting and for coming to these because this, it helps me continue to help you. It helps me as well. So a little bit about myself, some passions, our family, unique experiences with my daughter. So yeah, those are not all my sons. Anybody who watches, TV shows, yes, some of that is the cast of Supernatural, the cast of the Vampire Diaries, some bands, Marianas Trench and Headley that we've met. There's my family on a cruise, and of course my lovely dog Rosie sleeping. And I was learning ASL, American Sign Language, and we put a pause on that, so I should probably take that off of there because that's not current. Just to confirm, this webinar has been submitted. We have not got the approval yet, just simply because they meet once a month. You should have already hopefully received all of your credits for all of the past webinars. We're only waiting on January's, enhancing the bookkeeping Connection series to now be approved, but so this webinar has been submitted. There's every full expectation that it'll be approved as they all have been done. There will be 2 polls that must qualify or must be answered in order to qualify for the credits. Recording of the webinar will be emailed within 2 days and certificates for the CE credits will be emailed within 2 weeks of us receiving approval. As I say, they're meeting once a month. It's a new committee, so it might take a month or so. Just depending on when it is that they meet. So just a little bit about KATA accounting. So we've been collaborating with Jonathan and his team for a number of years. We've got multiple mutual clients. I think we figured that we're into the double digits at this stage, which is more than I've got with any other single accountant out there, which is great. It's just a testimony to Jonathan, his team, their commitment to customer service and their commitment to having good clean data, good clean files, and great reputation with that. He works in QBO, which is amazing. I know it's very challenging to work with some accountants who are still refusing to work with QBO. They've got great attention to detail, outstanding customer service. So thank you very much for all you have offered to us, Jonathan, and you can take it away now.
My absolute pleasure. I'm going to just share my my screen here. So today we're going to be talking about cash flow. It's not only going to be about cash flow. We're going to talk a little bit about, a lot about cash flow statements and how to interpret them. And then a little bit about things like working capital and cash flow forecasting, things that you can do to help your clients improve their cash position. So just a little bit about me. I am the founder of KATA Accounting Solutions. I was a member of the inaugural Intuit Accountants Council, and I have a long-standing relationship with Intuit. I work with them from time to time, but I'm not a regular or part of the trainer network or anything like that. was recipient of the 2018 Inspire the Industry. We're definitely forward looking here. We definitely are trying to do things differently than a lot of firms. And we definitely are using technology as a lot, not as much as we can, but I can speak more about that later. We're Elite ProAdvisors. I'm QBO Advanced Certified. Everybody who works in QuickBooks with us is at least basic certified, and it's mainly because they haven't had time to do the advanced certified yet. I am a trusted advisor for several bookkeeping firms out there, many of whom you'd probably recognize, but I'm not going to name. Considered a thought leader in technology and accounting. I love working with technology companies. Our tagline is to communicate, collaborate, and innovate. I'm the treasurer at the Japanese Canadian Cultural Center. So if anybody's in the Toronto area and is looking for something to do this weekend, we are having our Harumatsuri or Spring Festival, which is always a good time. That is Friday and Saturday, 12 to 5. I do volunteer on some other boards, but I'm starting to pull back from that to be able to serve certain clients better and deeper. So I also enjoy fishing. So in the beginning of May, I might be kind of hard to find. And I enjoy playing poker, though I don't play as much as I'd like to, and a game called MTG. And if you know what that stands for, you're as big a nerd as I am. So this is the agenda for today. Why is cash flow important? We're going to look at cash flow statements, which is looking behind. We're going to look at the direct method versus indirect method, which are the two methods of creating cash flow statements and understanding what they mean. We're also going to have a brief look at cash flow forecasting. This is not using an app. This is just some very basic ideas of how you can use a cash flow statement to help you understand where your client can get to with regards to a cash position. So this webinar is going to be a bit different. I do have spreadsheets that did not go nicely into the slides, and so I partway through will be pulling up those spreadsheets to have a look at some things. Interaction is great and important, and I encourage it. So if you have a question, please ask at any time. And yeah, we can address those as they come up. So first polling question. What is the most important reason to monitor cash flow? 1, cash flow can predict a business's future. B, cash flow is key to understanding a business's valuation. C, cash flow really isn't that important. D, cash flow is the highest source of stress for most business managers and owners. And E, cash flow is irrelevant to performance. So we'll give a moment for everybody to answer that question. I encourage you to answer to qualify for your CEC credits.
Yeah, we're sitting at 88% voting so far. So we'll just give another 10 seconds or so for that last person, that last holdout to vote. So we'll do a countdown now. So 5, 4, 3, 2, 1. Let's close the poll and share the results. There we go. So hopefully you guys can all see the results right now.
Yeah, I would agree with D that cash flow is the highest source of stress for most business managers and owners. There's two problems. The first problem is, of course, the most familiar one, not having enough cash. And then the second one is having too much. And what do you do with that? That can have long-term implications, particularly for somebody who's looking to exit their business. One of the things that is a very good tax credit we can take here is lifetime capital gains if you sell shares. However, there are certain qualifications. One of them is that the shares include only active business assets. They want that income, that extra retained earnings, to be dividended out to the shareholders so that the full rate of tax is paid on that. By having excess cash, it can create personal tax issues, investment questions, structural questions, all kinds of things. I really hope your clients are having those problems because those are good problems to have. And yeah, but I think most of us are more familiar with dealing with the business owner who is more concerned about having enough cash to continue operating month to month. So why is cash flow important? The number one is the most common reason businesses fail. Particularly, I always use the restaurant industry as an example, but I've seen it happen in other situations too, especially with entrepreneurs who tend to run with their hair on fire and don't necessarily consider how they're spending money. And a lot of money can get wasted at the beginning stages of a startup. Most restaurants fail because they fail to understand how long it takes to build a clientele. And even though they are a largely cash-based or credit card-based business, there's no AR or anything like that. Not having enough cash coming in can really deplete the reserves quickly and end that restaurant dream. That's why banks often are very hesitant to lend to new restaurants. So one thing that's very important is it helps understand how the business generates and uses cash. The two different techniques look in two different ways, and we're going to dig into that later. It can help identify areas for improvement or areas where you can find cash. A big part of that is working capital, which we're going to get into in a minute. You can help identify areas of finance. Working capital can be stretched or shrunk depending on business's needs. So one of my favorites is from Barb over at Dry Run. Cash is queen, I will use, because we've all heard cash is king enough times. So, all right, so cash flow statements. There's two methods of creating cash flow statements. There's the direct method, which is actual cash in and cash out. We'll have a look at that in a moment. And then there's the indirect method, which is built from statements. Cash flow statements are backward looking. They look at the historical movement of cash and help the reader understand how cash is coming in and how cash is going out of the business. They are a standard part of the financial statements. Notice to reader financial statements. That would be the balance sheet, income statement, cash flow statement, and retained earnings statement. Recently, I have seen the indirect method significantly more than the direct method. I think probably because it's easier to compile and you can create it straight out of the balance sheet and income statement with relative ease. Cash flow statements reveal a lot of information about the company that might not be reflected on a profit and loss, but it's not as useful as cash flow forecasting, which looks forwards. So the direct versus indirect. So in both sets of statements, there are three main sections. There's cash from operating activities, cash from investing activities, and cash from financing activities. In both the direct and indirect method, the financing and investing activities sections are the same. The operating section is presented differently, but comes to the same result. The indirect method is built from the balance sheet and income statement, and as I said, it seems to be more popular currently. So let's just review what these statements are. And changes in accounts indicate that cash was used or cash was sourced from those accounts. So for instance, if you increase your accounts receivable, you're financing your customer's purchase. This is considered a use of cash. If you increase your accounts payable, you're having the vendors finance your purchase, and this is considered a source of cash. These are two that are almost on every cash flow statement I've seen. The one exception is companies that don't have any accounts receivables. So the income statement, it shows the activity during a given period of time. It mostly shows movements of cash, but does include some non-cash items such as depreciation. So when we do a cash flow statement, we'll have to add those back. So the direct method in the operating cash flows section uses actual cash flows. It is definitely more difficult to calculate, but it shows who cash went to or came from. So for instance, you'll see segments like cash paid to vendors, cash paid to the employees, cash paid to the government, cash from customers, things like that. The indirect method is built from the balance sheet and income statement. It can still be difficult, but is easier to build than the direct. And it must have good, clean data and a chart of accounts in order to be meaningful and useful. The more chart accounts there are in the company, the more difficult it is. When we prepare notice to reader statements, that's when we prepare cash flow statements, and we prepare them from the notice to reader balance sheet and income statement, which usually groups a lot of accounts together. It's just becomes very burdensome to do it on a very detailed level, but there can be use to this. And if you can get a good understanding of this, this could be a good value add to offer some of your customers. So both methods provide a clear understanding of how cash was generated and how cash was used. The direct method ties to actual cash flows and shows who it came from or who went to. And the indirect method is built from the statements to help understand how the balance sheet and the income statement affect the cash flow of the company. So let's have a look. Let's start with a balance sheet. So in this balance sheet example, I'm hoping everybody can see it okay. We can see that this business has a very low cash position at the end of the year. If we have a look at their income statement, we can see that this might be very nervous, make an owner very nervous because there isn't even enough cash flow in there to cover a single pay run. So that's definitely something that might make the owner manager nervous. The prepaid expenses have gone up significantly. We don't know why, but perhaps that's something we'd want to look into. It looks like they've improved on collecting accounts receivables, but if we flip back over to the income statement, we can see that they're still carrying a good amount of accounts receivables considering their sales structure. Actually, it looks like they're doing quite well. They built up a lot of inventory. This is a very, very common area where you can see businesses get into trouble. Creating inventory without a customer to buy it, it produces a product that you then have to go and sell. And if you have to sell it, then you might not be getting the margins you want. We can see there is a bit of an investment in equipment, not a substantial one. As we can see from the prior period, if anybody knows CCA rates, we can see that this equipment was new in the prior period and they bought a little bit more, but that's their fixed assets and their investment section. So switching to the liability section, we can see that the accounts payable has increased significantly. So they're financing a lot on the backs of their vendors. Their credit card payables have increased as well. The amount of interest they're paying has increased. And this year they're paying income tax, whereas last year they didn't. I've just designed this whole scenario to be fairly easy to understand. And that's why you see nothing in the prior year, even though if we look at the statement, we can see there was an income. It looks like they paid off a good portion of their bank loan, but they still owe some money, or a fair bit of money, and that they still owe some money to the shareholder, which I'm sure the shareholder would like to get out. And just lowering down here, we can see that the retained earnings from the end of the prior period was negative. So that's why there was no tax. They had lost carry forwards, but there'd be no changes in equity. We're just making that section nice and easy. Let's have a quick, let's have a quick run through the income statement. So we can see sales have increased nicely at 20%. Cost of goods sold has stayed stable at about 75%. So the margins are 25%, pretty solid. Their expenses really haven't changed significantly. There are more professional fees there. That's a question maybe we should ask about. And there's more travel expense. So those are things we should ask about. As you can see, the retained earnings at the end of the prior year balances out to the 52,400 we talked about, and they do have income in both the prior years. So let's hop into the direct method of the cash flow. So as we can see, this method shows exactly where things came from. This column of positives and negatives are typical values you would see here. So we see that the customers we've received $1,225,000 from customers, but our sales were only 1.2 million. So where's the difference? The difference is in the collection of accounts receivables. So the accounts receivables has gone down $25,000. We've increased that. Plus we've had 1.2 million in sales. So that's where that comes from. The cash paid to suppliers is similarly calculated. If anybody cares to see, that is an ugly, ugly formula in there. What we're doing is we're looking at the total expenses that were paid to suppliers, and we're adjusting the AP and things like that. The cash paid to employees, very easy to determine, and the cash paid for interest is also very easy to determine. So that gives us $84,200. Now, if we go down and we look at the financing and the investing sections, we can see there was a $24,000 investment in fixed assets. That's the new equipment they purchased. We can see that they paid off the loan. Now, normally these amounts are quite often positive when they get a loan or they provide a shareholder loan, but in this case, they're repaying, so it's negative. So we can see the total cash flow for the business was negative $21,500, the opening cash position, and the ending balance. So now let's just, I'm just going to come back up to the operating section because that's the main section that differs between the two methods. So in this case, we're starting with net income. We're adding back our depreciation because that's a non-cash expense. And then we're adjusting our working capital. So our working capital are current assets and current liabilities. So these are things like the accounts receivable. Well, normally if accounts receivable increased, the use of cash, in this case it decreased. So we have an increase of cash to $25,000. The prepaid expenses did increase, so that's negative. And they had a big buildup of inventory, so that's also a negative. And in accounts payable, they're financing more on the backs of their creditors. Also with the credit cards, they're using those more, and they have more interest and tax payable. But as you can see, the net cash flow from operations is exactly the same as in the direct method. So let's just flip back there. So 84,200, 84,200. As we scroll down, we can see the other two are exactly the same, and the flow out is exactly the same amount of cash used, the opening balance adjustment down to the ending balance. So I'm just going to flip back here for a minute. Excuse me. All right. So before we go too far, are there any questions about any of the spreadsheet? Okay. So one of the things that we have to look at is what would the goals of the client be with regards to cash? Now, looking at the balance sheet, one of the things that I think it stands out big time is they don't have a lot of cash. And that's got to be absolutely nerve-wracking. So one of the goals has to be to have more cash on hand. They've had a buildup of inventory, so that's something else that you want to mitigate. So hopefully you can reduce the amount of inventory you have on hand and generate some cash in that manner. The accounts receivable seem to be doing quite well, but there are some things we can do with that. And the accounts payable, again, we're financing on the back of creditors. So these items here, these we could have a look at as well. So just a quick discussion of working capital. Working capital can be stretched and shrunk to provide cash. So let's say, for instance, the company needs cash. You can stretch the terms on what your payables are and really be aggressive on collections. Now, let's say times are better, you can pay your vendors faster, which they'll definitely appreciate, and you can collect at more of a regular pace. So I would suggest having good collection practices underway all the time. If you're in a situation where you're always stretching terms and you try to stretch them more, it can damage relationships with suppliers. If you are in a situation where you're paying on time all the time and then you start stretching them a bit, most suppliers probably won't make a big deal about it. But again, that comes to relationship management and the actual running of the business, knowing who you can delay payment to, maybe even negotiating payment terms when you're making a purchase, things along those lines. So let's say that the goal of the business owner is to have $100,000 in cash by the end of next year. Just going to go back into presentation mode for a minute. So there are a lot of app partners available for cash flow forecasting. I'm going to let Tanya talk about that a bit more. I've always loved Barb and Twyla. I think they're pretty awesome people, so I'm going to try running Helm up at the front. We did vet both of these, but it was over a year ago, which is not a fair comparison. Others that we've heard of good success with are Float, PayPie, and then there's a few others, Cashflow Tool, Frog, Cashflow Frog, Cash Pundit, things like that. So in my opinion, my humble opinion, the biggest weakness of all app partners is that they expect data to be up to date and accurate. If the data is not up to date and accurate, the results aren't as meaningful. So it can be very misleading. So you have to kind of be careful of how you're using any kind of cash flow forecasting app and understand the quality of the data that you're using.
Yeah, if I can just jump in on that point, Jonathan, if you don't mind. Um,
Cash flow forecasting, yes, please do.
okay,
Please do.
so I
Not at
used
all.
I used to be of the old school that, when I don't like integrating a lot of POSs because it just has, buggers up a lot of the books and stuff. And so I used to just give me your monthly reports. I'll enter your monthly report in. And Sherry Lee Mathers, I'm not sure she's watching, but her and we collaborate an awful lot as well on different things. And she'd been telling me for years not to do that. If you do that, you will not get accurate up-to-date data when you're trying to do the cash flow forecasting. So it's very important that you've got clean, accurate, and detailed data. So when you're doing that, your options are either integrate the POS system or use something such as Business Importer, Sassant, and Excel Transaction. We prefer Business Importer because I can use it on Google, which I can actually help the clients collaborate with and let them know that, you know what, hey, we can do this, get the detailed information in, but if you fill in the blanks here, it's not going to cost you anymore. So I find that to be really well because it's collaborative. But if you use one of those three tools or integrate the POS, you will get clean, accurate, detailed data that will actually make the cash flow forecasting valuable, because it's not valuable if you're just entering a monthly summary.
So can I ask a question? I understand that's from the sales side of things, but from the expense side of things, maybe you have a tip about how to ensure you're getting things on time?
Sure. We actually do. We've just started using a Google Sheet as well for that. And what we've been doing with our clients is we're checking with them every single month, every single week. We used to send a monthly. Most of our clients are good, but creating those habits is very difficult to start with, we found. And so what we do is automatically we send an email every month to say, hey, just to remember, like, we need everything before we reconcile. But again, that's not going to help this data when you're getting the data in 30 days later, because the client's letting it sit there and build up. Your cash flow forecasting is going to be useless. So what we're doing is we're really focusing on them when we onboard them, and we're re-onboarding our clients, letting them know why it's important. They've got the Receipt Bank app or the HubDoc app if you're using HubDoc, or if they're using auto entry. There's the three main ones to get the details to us very quickly. But now what we're doing is we're actually sending them at the end of every week. We've got a Google Sheet where we'll just kind of put in what uncleared items we have on QBO that we have not yet received a receipt for. So, and with that, we noticed that after a couple of those, the clients are like, oh, maybe I should start using my app right away. And they're forming better habits to get us the data quicker, so that something like this would actually be useful to run every week on them.
So we have a similar processes in place where we're looking at data every single week. Now it does create a lag of a week, but hopefully the client is being good about getting stuff in. One of the challenges we've had in working with startups is, let's just say as bookkeepers and accountants, we have a certain amount of ethical training that makes things very easy for us to understand. But sometimes you get a startup founder who sits on an invoice, and all of a sudden you'll see, you know, a transfer of $56,000, and you'll be like, what's this for? And oh, it's for this invoice from January that I never submitted because I didn't want our investors to see it on the books. And you have to have a really tough talk with those types of founders and just let them know that this is your professional reputation. If they're going to do things like this, you have to be willing to take the stand and walk away. Because if you're saying that, yes, I'm representing these are good working, like these are good books, and you find out something like that after the fact, it will damage the founder and the startup's reputation, making it harder for them to raise funds, but also damage your reputation as well. So it's not fair. Sometimes there's nothing you can do to control it, but it's something to be aware of. And we've experienced that a lot recently, working with some of the different startups.
Yeah.
So just to continue on about cash flow forecasting, it is very valuable to clients, but again, it's tricky to do because it's a moving target. This has a lot to do with planning, and helping clients plan will help them succeed. If they don't have a plan, they're just running on that hamster wheel, trying to keep the wheel on the rack. And that's not a good place to be from a business standpoint or from a personal stress and emotional standpoint as well. So I wanted to actually ask you again, Tanya, if I could get your input. We have embedded a cash flow app partner in some time. What do you think the big differences are? Who do you like? I know I'm asking for a dangerous opinion here, but like, you know, like what do you suggest? Are there any that you would absolutely not use? Different things like.
So what I'd like to do is bring Sandra and Leanne on this, because anybody who knows me, I guess, will know that I personally, my mind does not think this way, which is hilarious that this is what I do. So I don't handle really that part of it with the clients. I mean, you know, there's certain things I'll pull out and I'll talk to them when coaching back and whatnot. But to me, cash flow, if you don't have the money in the bank, don't buy it. If you've got the money in the bank, buy it. And forecasting is like a magic 8 ball. It is so subjective. So because, you know, I'm old school with my grandfather, my mind just doesn't work that way. So Leanne handles that because her mind does work that way. And Sandra was the one who really got right into the app. So I'm going to bring them in. And then I'll mute myself because, of course, we're all in one room. So we'll have to be careful to mute ourselves one at a time. But of course, because we did the cash flow forecasting, 12 apps, 12 weeks, and so I'm just trying to find to bring them in. So yeah, we definitely have a lot to be able to add on that of what's been updated, what hasn't been updated. While I'm bringing them in, some of the ones that I tended to favor from what I saw that just worked the way that my brain worked, I'm just bringing both of them in right now, was definitely I liked cash flow tool and PayPal, where I think the way that worked with my brains. I know they're not necessarily the favorites here with Leanne and Sandra for different reasons, of course. So I think they're in. So if you ladies want to pop on your opinions one at a time, don't care who goes first.
I'll turn on my video because otherwise I look like I'm Sandra and it looks like she's in here twice. It's kind of a loaded question because there are so many apps with a lot of, like, some of them have some really great benefits, you know, that I might choose one over another. In some cases, and this is a little bit, it might be a little bit partial to our firm, but because we work with very small entrepreneurs, the reality is sometimes cost point does come into, you know, our decision. Like we do have very small entrepreneurs who don't have a lot of money, and I might want to work with a $50 app, but I might not be able to afford a $50 app. So, you know, there's a lot of variables there. Internally, I would say right now, the ones that we are putting our most focus on would be KATA and PayPal. But that doesn't, yeah. So right now, we like KATA from the standpoint of it's great for pulling out that, those questions, and it is something that we can allow our clients to have some access to, so they could ask questions without getting into their books and messing around. So I like KATA from the standpoint of being able to pop in and ask a question. They have some really great dashboards on their paid version, which is still, when I talk price point, their paid version is $25 per client, so it's not a completely like outside the realm of range for a lot of small entrepreneurs. PayPal has some really nice dashboards. They're good to look at. They're easy to view, and the colors in that, I know it sounds funny, but I feel the colors are attractive because when I'm showing a client, it stands out and it's not a bunch of numbers on like black numbers on a white sheet and the client's eyes are glazing over, right? Like it's more visual for them.
And visuals, a
Okay.
good story.
And just to add into that, I think for anybody who doesn't know what KATA is Siri for QuickBooks, essentially, which makes it really neat to be able to pull out information. You can just say, you know, what were my sales like on this date? And it actually even tracks the weather on that date. So you can see how the weather is affecting your sales. So it's really interesting with that. And then I think, Leanne, just correct me if I'm wrong, but Dry Run, where I know Leanne really loves Dry Run, again, it's just price point. Sometimes that will make the difference between some of our clients being able to afford it initially or not. But Dry Run is really good for the changing of scenarios, is it not?
Yes, that would be correct. And I love the layout of Dry Run. You know, when you talk about the way your brain thinks, it's appealing to me and the way my brain thinks, and it's great for the scenarios. You can run scenarios in a lot of the other programs, but yeah, if I had endless, money that I could spend with my clients, then I would probably, I do favor Dry Run. But that being said, that's not always the case.
All right, and Sandra, when you were more involved on the webinar series, was there anything that maybe you found that you liked that one did better over another, or any preferences, anything that you wanted to bring in?
I would just have to say, for the most part, like, yes, even though I was on it, I didn't really dig too deep into the apps, but a lot of them do, and I would suggest this, a lot of them do, you can go in and basically try it for free. So I would do that, and I would try to choose an app that you'd be able to use for multiple clients, because then you're getting more out of your dollar basically for what you're spending. So that would definitely be my input on that.
Interesting. So
Right.
can I ask, if somebody out there is looking to vet cash flow apps, what would be your top 3 to look at?
Okay, just while we're waiting for people to type those answers in, we do have that we can send out with this. First off, if anybody wants to go back and look at any of those apps that we did on my YouTube channel, are all of the ones that we did, all 12 of them. So they're there, and they were a little bit more of an in-depth deep dive rather than a regular demo. Excuse me, as well as we have an Excel sheet that is a one kind of comparison of what each of the apps offer, what makes them different. So I will make sure to include those out with us. I've already had Jonathan's permission to include those out when the email comes out.
Yeah, and sorry, I still have to deliver to you the Excel format of that statement that we're playing with. So
That's fine. By end of day is fine, so we can get it just in case some of them go out tomorrow.
yeah. So if I can circle back, Sandra, Leanne, what would be the top 3 you'd recommend vetting? It sounds like KATA is a no-brainer to look at.
Yeah, I think Chata pairs nicely with any of the other apps. So to me, absolutely, I would look at Chata. PayPay, as I say, I do like the way it's laid out, and the price point is really reasonable. So because of that, I would favor it a little bit higher on the list. That being said, as we kind of mentioned on the spreadsheet, like there's a lot that do similar functions. And you can kind of start to look across and see which one you think hits the most. I do favor dry run, as I say, like it would be my one of my top 3. But what I would probably do is look at what hits the most points and then look at the price point and say, well, if I moved, because like as Sandra was mentioning, if you can move 10 clients on, your price point may come down for that app because they're tiered price points. So, you know, it might be $50 for one client, but as soon as you hit 10, you're suddenly paying $25 per client, and it brings it back into the realm of maybe affordability, depending on how many clients you have that you're going to execute this on right away. So if you really want my top 3, it's going to be Dry Run, PayPay, and Chata. But everybody's going to be a little bit different, and I would definitely use the resources going out to review that.
And Tanya and Sandra, would you echo that, or would you have any?
I would echo that absolutely. I know one of the things that we do, because a lot of our clients, again, they're small, they don't understand cash flow and how an a cash flow advisory package can help them, or they don't see the value in paying more for it. So if we're working with the free version of Chata and PayPay, for example, what we can do is that's now costing us out of pocket like less than $10 Canadian. I think PayPay is in Canadian, but anyway, less than $10. And then we can turn around and then just work with them for 3 months, give them our time. It's only cost us out of pocket, like, maybe my time to pay, like Leanne to deal with that. But then, after 3 months, we can show the client how this is beneficial and then turn around and maybe charge them $100 for that, which is extremely cheap, but maybe that's all they can afford in the budget, which is why we're using the cheaper ones. If, we could bill them at $250 and show the value at that, then yeah, that's when we're turning around, we're bringing in dry run and, some bigger hitters. But, yeah, that's kind of where we like that, and that Chata has the free version. Again, you can't set the dashboards. There's you have to there's some limitations to it, but it's great as a stepping stool to start to show your clients the value.
Yeah, I've liked Chata for a long time. I think that's a very interesting program.
Yeah, and then Sandra, did you have anything else to add?
I would definitely mirror that as well. And also, we didn't actually have these guys in our financial series, but our boot campers have actually used them. And I would say Giraffe, so that's JIRAV. I've heard a lot of good things about them as well, but I haven't personally tested it to say whether it is or isn't.
Okay. My first question for them, last time I looked at them, they didn't operate with QB Canada, but like I said, over a year ago. So definitely out of date information from my perspective. So, all right. Well, thank you very much for the input on that. That's something we haven't looked into as a firm in some time. We do a lot of cash flow forecasting, particularly for startups, but we use ridiculous spreadsheets, and it gets very detailed, very involved, and it is a premium offering from our firm. So we're going to have a quick look at using a indirect cash flow statement to understand how you can make some adjustments to achieve the target of $100,000 in the bank. So these are some of the assumptions for this cash flow forecast that I'm going to look at. Inventory was built up and needs to be sold off. The client wants to improve how vendors are paid as part of a larger strategy so that when they do need to stretch their terms, that there's less argument for it. The client wants to pay off some of the interest owed. Again, this is a very simple plan. There are no interest amortization schedules or anything to back any of this. The client wants their money back, their shareholder loan back, and they want to continue to reduce the bank indebtedness. And the client is not planning on any major purchases. So these are kind of the assumptions that I'm taking in this. So I'm just gonna get out of this and hop back over. So essentially what I've done on this forecast is I've just taken the cash flow statement and made some adjustments. So we're going to assume that the net income is $100,000. Now, of course, since we're doing this pre-tax, we don't get to see the taxes payable. There's no depreciation booked, things like that. We're going to assume that there was no increase, no change in accounts receivable. They kept that stable. No change in prepaid expenses. But they were able to sell off 60,000 of that inventory. They did pay off, or they did, I have my number backwards here. they were supposed to have paid off some of the cash from accounts payable and paid off the credit card balance and the interest. So that's generating cash. Now we're going to have to take that with a grain of salt because of my error. But they paid off 50,000 of the bank loan. They paid off the shareholder loan. They've had a cash flow of $101,000 and ending up with $104,500. Now, of course, I did make a mistake on the spreadsheet, so apologies, mistakes do happen. But that gives you an idea of some of the things that can be done by stretching your terms on your payables or by increasing the speed with which you collect receivables or selling off that excess inventory. Inventory is one area where I've seen a lot of companies get into trouble, both by not having enough and by having too much. And quite often it can be disastrous, particularly if your inventory takes a dive in value. So I'm just going to go back to the presentation. We're on to our last poll question. Understanding cash flow statements will help the reader understand A, how much cash the company has, B, how cash is going to be used, C, how cash has been used, D, upcoming sources and uses of cash, or E, A and C. We'll give a moment for everybody to answer.
All right, seems like everybody's voted. Well, it's a 7 of 8, but Sandra can't vote. So I think that's her. We'll give it about 5 more seconds just in case. Oh, there we go. No, it was somebody. Perfect. There's 100% vote. So let's end the polling and share the
Awesome.
results.
All right, A and C is correct, yes. Remember, cash flow statements are always backwards looking. So yes, they show how much cash the company has, they show how it's being used and how it's being sourced, but always looking backwards. Cash flow forecast would be more about the upcoming or what's going to happen down the road. Okay. So again, this all comes back to preparation and planning. I know I used this quote in the last one, but I think this is something that there's a lot of value in. And if you can get into that advisory stage of your practice where you're helping clients to plan how their business is going to go and then leave it to them to execute, you can really, really help and become that trusted advisor. So just my connections, if anybody wants to connect. And I think we have 10 minutes left, so we have lots of time for questions. Tanya, have you seen any crazy stories about cash flow challenges, cash flow issues?
Probably, but I don't know what pops to mind. I know Leanne, Sandra, you guys have anything to add to that? I mean, no, and I know there is some, just putting us on the spot, right?
Sorry. I just thought I'd ask. I mean, there was such great input.
Well, I mean, the biggest thing is, and this is a story of every client, or probably not, well, possibly every client at some point, until we start working with them or until you guys start working with them. But just the same thing that they don't understand it. They don't understand that, oh, the GST that I collect isn't mine to spend. So they're not managing their cash properly. So we just, advise clients, take this certain percentage and move it over to the separate bank account. Automatically move it over. That way it's, because otherwise if they see it, they think they can spend it. Oh, it's in my bank balance, it must be mine. They forget that they've got corporate taxes. They forget that, that they've got their GST. They forget, oh, my payroll taxes have to be paid. So with them not really understanding, and we've seen businesses that should have been good businesses have to be forced to go bankrupt just simply because of that. And I think that's a story that every single one of us has dealt with those clients, and working with them properly with, something like that. Even again, those little tips, take this percentage and move it aside. You don't have to get as in depth immediately, but you can start to get there, and they can see the value, and, you get them to start to understand that.
Yeah.
That can make the difference, right? So
Yeah. So when I'm talking about working capital, you do not touch anything related to receiver general.
yeah.
You pay that on time and you pay it regularly. I have literally seen families destroyed because somebody decided they weren't going to pay source deductions. That is something that can follow the director of the company through bankruptcy, and they can go after all the personal assets as well, and they will. It is not something they're forgiving about at all. So again, source deductions, withholding tax is another one that may or may not come up as often in everybody's clientele base, but source deductions and HST for sure. Don't play with those when it comes to stretching your working capital.
Yeah. And then I was just going to say, managing the AR, we've got a construction client that, and construction is horrible for this, their AR, because especially if they're, they're subcontractors of subs, the way that they get paid out, they might not get paid out for ages, until after the building is built, and then everybody's got, a 90-day payable, and it trickles down. But their AR, and we had these same conversations with them over and over. They're like, well, we should be, we're $1 million company. Great, you're $1 million company, but 800,000 of it is sitting in receivables. It's not collected. That's why you're in debt, because you have to collect it. So again, but I think that's, something that, every single one of us have, again, encountered one type of client with that they don't understand. They just see, well, no, I've got this much in sales. You can't count on that money to spend it until you've received it.
That sounds like a really good opportunity for in-depth cash flow forecasting with a client like that. Because I mean, yeah, you have to plan. Like, your trades aren't going to wait 120 days to get paid. They're not going to continue working for you if you're going to pay them on those kind of terms. But your customers, the people you're building for, there's could be a 10% holdback that doesn't get paid for 6 months after everything is done. There could be all kinds of things like that that need to be planned out, thought out, and brought into the understanding of the managers of the business.
Well, and not to mention that, I think when you're dealing with that type of industry as well, I think it's really important that they understand what the job is costing them. So job costing analysis could, come into play with that, because that same client underbid themselves or like to try to get the job. But when they looked at what they paid, they lost money. But they didn't see that at first. They just thought, I need to get the job. I need to get the job. I need to get the job. So again, that would be a further level of your cash flow forecasting. Get into, again, the job costing analysis with them to be able to help them.
And little things can make a huge difference. I was working with a startup the other day, and there was a minor error. They had failed to multiply a 74-cent cost of goods sold or cost of production of an item into their spreadsheets, because it was 74 cents per kilogram, but they needed 2.5 kilograms of product, and they forgot to multiply by that. But it affected their actual cost to produce that product by, I think it was like 12% in the end, which, when you're producing tens of thousands of products, can really add up. So understanding those kind of things is also very important. We talked about the person who lets the invoice sit on their desk and doesn't tell you about it. That's something that we've encountered. Another thing that we've encountered, and this is something that I'm always asked, like, what's the one piece of advice I'd give to a small business owner? Number one is pay attention to your money, because if you don't, somebody else will. I was working with another organization, and they're an older organization, and they've had some turnover and whatnot, and they found $100,000 US dollars in an account that was earning very, very little interest that they owned, but was not on their balance sheet, had never been recorded, nothing like that. And like, could you imagine like the impact that could have to somebody
Wow.
and how much
Huge.
opportunity cost they lost by not dividending that out to shareholders or investing it properly or so on and so forth. So
Well,
definitely like, you know, having a very good handle on the finances overall is the beginning to having the ability to do good cash flow forecasting.
not only that, employee embezzlement. That is
Yeah.
something that I've heard. We've not encountered that until this week. I've heard of that with other people. I'm like, how can you not know that? But if you've got somebody who you trust in receiving that and you're not looking at the books, and that happened to one of our clients, that there was a substantial, she was actually, it was being paid out on the payroll side of things versus the income side of things. But you know, they were basically saying that, you know, running payroll took them an 8-hour day. Well, we all know that running payroll doesn't take an 8-hour day. The business owner did not understand, didn't know, and it turns out that there was like thousands of dollars in stuff that was being put through as that, just because again they weren't paying attention.
Okay.
So.
All right. Well, we've gotten to the end. There's just a couple comments here. Thank you, Premlada. Thank you. I'm glad you enjoyed it. Karen, Bob is no longer with KATA Accounting. He's downsized and moved away, and I think it's kind of, you know, he's in his mid 70s now, so I think it's kind of at that time.
Get him
Yeah,
to enjoy his life.
I still love him, and I miss him terribly as well. So. If there's no more questions, we're actually about 2 or 3 minutes early.
All right, perfect.
Okay.
So that's great. So thank you everybody for coming. Thank you, Jonathan. Again, it was great,
My
and we
pleasure.
will
Thank you
send
for
all
hosting.
of. Oh, thank you, and we will send all of these attachments and everything else. We'll go it again within the next 2 days, sometime tomorrow and Friday. You should see them coming in. Zoom does it automatically, so I have no control over the timing. So again, within the next 2 days, you should be getting it. So Jonathan, if you can get me anything you want me to include, just by tonight, you know, before the end of business today, that would be
Okay.
great.
I'm not going to include the slides because those will be on the recording, but I'll send the spreadsheet. So if people want to
Okay.
play with it or look at my mistake or something like that, they can.
All right, awesome.
Thanks, everybody. And please, just one final request. If there are any ideas for future webinars, I'd love to hear them. Otherwise, you're going to be stuck with whatever I decide to do. Okay. Thanks.
All right. Thanks, everyone. Have a great day. Take care.
Bye.
Bye.